So let's kick it off. Hello, everyone, and welcome to this Fireside Chat on how to integrate alpha into your ESG portfolio. I'm joined by Director of Portfolio Management and Sustainable Investing at PanAgora Asset Management, Mike Chen. Welcome, Mike. I don't know if you want to add a little bit there
Thank
in
you,
terms
Peter.
of introducing yourself.
Absolutely. So thanks for joining our conversation, everybody. Hopefully this is informative and also entertaining. So my name is Mike. I'm a director of, as Peter said, portfolio management and sustainable investing at PanAgora, and we're a Boston-based quant asset manager. So roughly about 40 billion AUM, and we've done some work in ESG that we'd love to share with people.
My name is Peter Hafez. I'm the Chief Data Scientist at Ravenpack. We're a big data analytics company with expertise in natural language processing. We have been around in the space for close to 20 years by now. And we are working with clients across a broader sort of quant investing, but also in more recent years, we have started working with clients that are interested in sustainable investing. But let's kick it off. I mean, we only have 20 minutes to discuss this very interesting topic. So Mike, if we look at how PanAgora thinks about ESG, are you taking more of a risk management approach to it, or are you also trying to integrate alpha into the mix?
That's a very good question, Peter. So actually PanAgora started on ESG even before, I guess most of us knew what the term ESG meant. Definitely anybody at PanAgora, right? We started looking into ESG just because we thought this is something that's relevant to how a portfolio would perform. And we started investigating into how we can systematize these various insights, such as, does the company have a correct incentive structure, right? Do the employees at a given company, are they happy, or, do they hate their job every day, right? So we just thought that naturally these things would actually impact how a company performs. So I guess you can say that, we look at it from an alpha perspective. We always thought that, well, even though these are intangible matter, because, the quality of governance, employee happiness, so on and so forth, they're not necessarily reported in financial statements, but they have very tangible impact on how a company will ultimately perform. So we always took the approach that ESG, if done correctly, should be alpha drivers. So that's the way we approached it. What about you, Peter? Well, how does Ravenpack think about ESG? So you guys, been around for a really long time, and just do you guys find alpha in ESG data and analysis, or do you mostly find risk control?
I would say, I mean, it's both as well. There's definitely risk components to the ESG data that we produce as well. I mean, I would say that our primary focus is more on the controversy side. Of course, we're also looking at picking up general sentiment around ESG topics and so on. But we are very focused on detecting what we consider actionable events, and a lot of these events would fall into an ESG taxonomy directly. You can think about it almost like as a SASB inspired materiality map or taxonomy, right? Where you are picking up, that could be anything from fraud to reorganizations or something to do with water waste management and all these sort of things. So it spans quite broadly. And so our clients are able to consume this information in real time and build indicators on top of that as they see fit. And some of the research that we have actually done in the space, I mean, is very much on the alpha side. We can clearly see that when companies are associated with some of these controversial topics, if we look at something like fraud or scandals, I mean, not surprisingly, firms will underperform for quite a bit of time. But what's also interesting to see is that you also tend to see an overreaction in the market. So there's also a possibility of playing the reversal game here, right? For clients, for investors who want to do that.
That's very, very interesting. Okay.
But if we look at, I mean, as you mentioned, sustainability or social responsibility investing, socially responsible investing has been around for quite some time. why is it, and in various forms, right? So
Yeah.
why is it kicking off now? Why has it become so popular in the last few years? We have definitely seen a surge in interest, both in the media amongst investors.
Yeah, absolutely. Well, that's actually a very interesting question. I think there's actually a confluence of factors, right? So it's almost like the perfect storm. First of all, you have the changing economic landscape. Think about 30, 40 years ago, right? Well, 40 years ago, roughly. The biggest company in the world are GM, AT&T. These companies actually own physical assets, right? They own plants, they own equipment, they make they make things generally that are composed of atoms. But fast forward now, most of the companies are making bits. Really, a lot of it is based on media, based on content, based on decision, based on IP, based on the brand value, right? Based on the network effect. These are not really so-called tangible items, right? So the traditional accounting methodology, which is basically derived in the industrial era, don't really account for these things properly. So as the underlying economy shift, investors such as ourselves naturally needs to shift along with it to figure out, okay, if I value Google based on how many assets they own and the server farms and buildings, they're not worth nearly as much as what they're worth, according to the stock market. So how do we evaluate company like Google? How do we evaluate companies like JP Morgan? Right. So you naturally go into this area of intangibles. As I mentioned earlier, when we started, we didn't know this was called ESG. We just thought, well, we should look into these intangibles because they actually, matter for the companies that we're investing in. Right. So that's number one. The underlying economy is shifting. Second thing is there's just been an explosion of data and algorithms that allows the analysis of these so-called intangible or ESG metrics. Right, because as I mentioned earlier, the traditional financial statement, they don't really have they don't really account for these. So how without this alternative data explosion and computation explosion that we have witnessed in the past 10 to 20 years, how do you actually analyze this? Right, you really can't. So you have this changing economy, you have this explosion of data and algorithms, which allows you to understand these intangible matters that comprise of a majority of the market cap these days. So that's number two. And the third thing is really generational shift, to be honest with you. The young tends to be more idealistic in general. And they tend to care more about the climate and society and so on and so forth. And right now the people in the 30 to 40 range, the millennials, late 30s, I guess, is the biggest generation since the baby boomers, right? So they are the offsprings of baby boomers. So we have this massive generation that's are starting to work, are starting to invest, are actually starting to inherit money from their parent generation. The baby boomer to millennial wealth transfer is the biggest ever. So now obviously they want to invest according to their own value system, right? So I think that's the third part. And then you have also the regulatory environment, right? The European Union, and increasingly we're seeing other parts of the world, and even in the United States that we're seeing this shift. So there's a bunch of things that's coming together simultaneously, which I would say is the perfect storm, right?
Yeah, that's very interesting, and I totally agree. I mean, and I guess the financial industry as a whole is also not too sad about being able to rebrand into a little more sort of social conscious coming out of the financial crisis as well, some years ago now.
That's right. And I do think that's actually a very powerful motivator too. I mean, I think people in finance do want to they don't want to be seen as the bad guy in the room if they can help it, right? So I think there's a big motivator.
Surely when they go home and speak to mom, they want mom and dad to be proud of
that's right
of where they work.
That's right. That's absolutely right. Yeah.
So I mean, if we look in the past, and we've looked at the evolution of sustainable investing, it's sort of come a little bit more from the manual process where you have, business analysts, research analysts looking into and really going deep and analyzing, companies and trying to understand their business and all these sort of things, the supply chains potentially and so on. But there's been a pressure on the industry to go to sort of become more efficient. There's an ongoing battle, right? The survival of the fittest here. And that has also given room for the emergence of quants and more quant-driven processes in this in the asset management industry. Where are the quants playing in the sustainable the ESG space? Is it realistic? Is it that they can play a role, or is it just too complex?
That's a very, very good question. It's something that I've actually personally worked on for a really long time. So first of all, I don't think every investor believe in quant ESG. Let me just put it out there, right? So we're still encountering doubts about like, well, if I want to do ESG, I want to invest with fundamental managers. I want to invest even with people who could really dig in, talk to the management, see the whites in management's eyes before I believe you. So why are you guys doing this? Go away. But having said that, I really do believe that there is a lot of opportunity for quant investors in the ESG space, and because there is actually not very established, right? If you think about the traditional ESG, fundamental ESG is not established. Well, quant is even less established. So where do quants have an edge? And actually, my CEO and CIO and myself wrote a paper on this recently. We published it about 2 weeks ago. We can identify actually 4 things. So number one, ESG is values-based investing, right? It's when you invest in ESG, you don't just want to outperform. You want to actually have your portfolio align with your own personal sustainable values, right? So it's not just a one-dimensional goal; it's a two-dimensional goal. The traditional investment is basically you want to maximize your alpha for a given amount of risk. That's sort of the whole modern portfolio theory stuff. ESG really can actually extend that modern portfolio theory from one dimensional along just the alpha dimension to two-dimensional, alpha plus sustainability. So quants have that ability. I think that's first of all, that's number one, right? We can really incorporate this higher dimensionality into building a portfolio. Second thing, something we mentioned earlier, right? There's a lot of data. There's a lot of data that naturally come into the world, and quants are more adept than the traditional manager. At least there's less loss in translation when they use these alternative data, big data, into investment. So that's number 2. Number 3 is quant can systematize domain knowledge, right? So if you think about a fundamental manager, they probably know 20, 30 stocks really, really well, but they want to extend that. Right, they really can't. So quants, on the other hand, as long as you have a fundamental intuition and you build it into a process, you can roll it out to as many stock as that intuition fits, right? So there's the ability to scale with quant. I think that's a huge advantage. Lastly, it's a little bit of I think this is actually an alpha opportunity, just to be honest with you. Recall like when ratings agency came out with bond ratings, right? So all of a sudden, triple A's and where the investment grades, at least, and the junk actually has a huge separation, right? Because people want to invest in investment grade, and the junk, unless you're a high yield investor, you really can't. Well, now we have these rating, they're not formalized yet. We have these rating agency by MSCI, by Systematic, so on and so forth. Well, you know what? So it's actually possible to predict where those ratings are going to be 6 months to 12 months out in the future. So if you can predict that, and given the amount of money that's following these ratings, naturally there's going to be some flow, and then naturally there's going to be some alpha opportunity. So that's where we see quants as having an edge when it comes to sustainable investing. But Peter, I would love to get your thoughts on it. So I know that you guys have worked with your clients on sustainable investment space, and I know that a lot of your clients are probably asking this question: what values do you think a systematic approach can bring to sustainable investing? So what are your thoughts?
I think first of all, also to get back to what you highlighted, I mean, quants can consume a lot of content, right? And we sort of fit into that. We track more than 25,000 sources globally of textual content and continuously expand. So it's sort of like giving you the scale in information extraction to some extent and being able to plug that into your process. And you can do that systematically also in multiple languages, right? So you can pick up what's actually happening in local press. And I think that is particularly important in a space like ESG, because there will be a lot of things that, that where you have to track information more locally to capture information across the supply chain and so on, that is definitely influencing your ESG profile, if you may say, right? And so that's sort of one part of it. The other part is also, of course, beyond the scale is also the speed, that you are able to react more quickly to when controversies hit. And also understanding how that plays out over time in the news, if it is becoming a bigger or a smaller issue. And even understanding how all of the players in around a particular controversy, who they are. I mean, we have looked into, for instance, using our data, if you were to map out the Dieselgate scandal around Volkswagen now a few years ago. And it's quite interesting to see how that sort of was spreading across the industry, right? That you initially saw all of the German car makers being brought in on suspicion of collusion, and there was, GM was using similar sort of cheating tech as well. They were brought in, and it also had sort of spillover effects to Renault, who had to recall 15,000 vehicles, I think it was, for additional testing and stuff like that. So it has sort of these follow-on effects that can be quite difficult to track for, let's say, humans, but you can do it systematically through network graphs of links to scandals. So we definitely also see it from that perspective, and also just understanding information flows, or what could also be considered ESG life cycles. So understanding how topics are being discussed, new ESG topics are being discussed, in documents coming out or material coming out of NGOs. It goes into regulation or more, GOs type of documents, and you start to go into trade journals. You might see analysts starting to react to it, and then it might hit the news, and then at that stage it start hitting prices. So trying to understand what sort of that next layer of topics that will be important or being discussed, I think is interesting. And we're also seeing uses. I mean, you mentioned this thing about predicting ESG ratings. I mean, you can see this kind of news information or tracking all of these as almost like a nowcast, and also trying to understand what is it again that triggers a ratings change, or potentially even also looking at fund holdings of ESG companies that can give you almost like an implied rating, right?
That's right.
But trying to understand what are the types of news that triggers a readjustment in portfolios, and then trying to get a sense for what is the implied weighting function between the E, the S, and the G, for instance. What is most important? What is triggering reallocation the most? That's I think there's a lot of interesting things that can be done in that area.
So let me just follow with you, and then actually that's a super interesting topic. So do you see that with the Black Lives Matter movement, say in the U.S. last summer, do you see that S getting more weight in the ESG the composites you're tracking, and see as social issues become more impactful to overall stock movements or ESG fund holdings?
Yeah, I mean, you can definitely see and start to track these type of topics and seeing what are the companies that or even countries that are being associated, to sort of see how that goes across borders, how it of course started out in the US but has really spread at least to Europe, and seeing companies that potentially start to to participate in some shape or form. I mean, perhaps less so companies have participated in something like Black Lives Matter. It's more been sports and stuff like that, right? Sports clubs and so on. But if you look at something like Me Too, I mean, you have really seen that sort of plowing through sectors and so on, and then getting, I mean, now with the pandemic, we can talk about first, second, and third waves. I mean, you're seeing that with the Me Too campaign as well, right? New industries suddenly have a blow up, or a new country, an industry in a country, something happens and then it blows up. You know, you do see these sort of things.
Wow, that is quite useful, actually. So I guess what you're saying is that if it becomes popular media, say to the Economist magazine or New York Times or, you know, Sunday Times of London, is that a British paper? I guess the Sunday Times, then it's a little bit too late, right? So you really got to track at a grassroots level, maybe from the NGOs, maybe from, you know, government reports. That's really not popular yet. Is that what you're saying?
Yeah, I mean, it's all about trying to map out that life cycle and trying to understand what is the future thing you need to care about. But I think the way that we approach this whole space, and I think it goes quite broadly when you try to associate it with risk, that you need to think about three different, let's call it technologies that you need to think about. One is what I would call trending topics, right? Stuff where you're saying what, and this is sort of the life cycle idea. What is the thing that is popping up that I'm not aware of, but there seems to get a lot of traction behind it? You need to be able to pick these things up. Yeah. And you could do that, let's say, through this sort of source bucketing approach. You need to also look at things that, I mean, identify things that happens again and again, right? Fraud, scandals, you know, layoffs, reorganizations, appointments to boards, firing, all these sort of things that could be interesting to track as well. They happen again and again and again. You can track that through fixed taxonomies that allows you easy backtesting to see what has happened in the past. How should I react to it going forward? And then you sort of have to have technology that can address what I would consider like a black swan, or almost like an unknown unknowns, because the unknown unknowns,
the COVID pandemic,
the stuff that suddenly, you know, goes from being unknown to becoming known, right? But then how do you track that going forward? So you want to be able to almost curate data sets on the fly. So you need flexible technology for that. Curate a data set that says, this is what I want, and now I can track it going forward, and understanding how it spreads. So these are sort of the three ways that we speak to clients about, and how we help them to say, you know, how can we structure this? How can we support you in that process of looking at it from that perspective?
That's really powerful. That's also super interesting.
Yeah, I think it's a very interesting space, and I think we are very early in the space in terms of how technology, how NLP, how, you know, that whole workflow that should look like, and what we can do with it. And I think it's super powerful also from let's sort of say, from a greenwashing perspective, which is a challenge in the industry, right?
Yeah,
but I
absolutely.
think as you are turning your approach more data driven, more systematic, I think, I mean, you can also be, if not open, but you can explain your processes. They are more, right, let's call it objective. And you can say, look, this is my process. It's more transparent. There's no greenwashing here, right? At least from that perspective. Of course, we still have the challenge on the corporate side. And that's also an area actually where people are interested in NLP, being able to track what companies are saying versus what they're really doing, right? What's showing up.
You know, funny thing is that actually, even with NLP, right, you can detect possible fraud. Actually, you know, so obviously the words that people say, but how, not just what they say, but how they say it, right? Do they hedge themselves when they say it? Are their tones different? And I think that's actually a really interesting area to look for.
Yeah, I'm sure we could keep discussing for another couple of hours, but we are probably unfortunately running out of time. But I think we agree that there's a lot of interesting things to still explore in the space, and data and technology is part of that. But perhaps also with a human in the mix, That's always a good thing.
I'm hoping human will never get taken out, so I'll have a job.
Exactly. Well, I really enjoyed this discussion.
Same here. Thank you, Peter, and thanks for everybody for dialing in.
Thanks, everybody. Cheers.
Bye bye.
Bye bye.